Hello everyone, welcome to lecture 2 of employees benefit. In lecture 1, last lecture we had discussed short term employees benefits with its practical questions, how to do the accounting for the same. As well as in the last lecture I made you write that accounting for post employment or retirement benefits and long term employees benefit is going to remain same. In today's lecture we will be discussing these two things, how to do the accounting for post-employment or retirement benefits and long-term benefits with its practical questions. Okay, 5 to 6 different practical questions we are going to take in the today's lecture. So understand the concepts thoroughly well. Be attentive. And of course, take out your notebooks because you have seen that your study materials notebook is very difficult. We are going to write the same things in simple language. Without wasting time, give the heading in your notebooks. Post-employment benefits and long-term benefits. This will cover all the study material points page 5 to 7. All the theory which is covered in your study material from page 5 to 7 will be covered in my today's lecture. Okay. First of all, which are the various types of post-employment and long-term employment benefits? Understand? We had seen various examples. In post-employment benefit in the last lecture, we had seen example of gratuity, pension, provident fund. These are to be given after the employment is over, when the employee retires. And in long-term employee benefits, we had taken sabbatical leave, medical disability benefits, etc. So basically all these what we discussed, gratuity, pension, provident fund, superannuation fund, retirement funds, sabbatical leave, and this medical benefits and this disability benefits, they all are mainly of two types. Okay, all of them are mainly of two types. So write this in your notebook. There are two types of post-employment and long-term benefits. The first one is defined contribution plan. This is important. Okay, defined contribution plan, and second is defined benefit plan. Now, what do you mean by defined contribution? Defined means fixed. Defined means fixed, or defined means very well known in advance. After the word defined, what is the next word? Contribution. It is such a plan of employees' benefit in which what contribution employer has to give from his pocket is already fixed and defined and known in advance. Okay, what contribution employer has to give towards, okay, whatever contribution employer has to give towards that employee's plan so that he accumulates good fund in future to pay that amount of fund to the employee is very well known in advance. For example, provident fund. So contribution of employer towards the plan is fixed. Like how does the employer give the provident fund? Maybe 12% of salary, basic plus DNS allowance and income tax. You studied all this. That provident fund's contribution is 12% of salary. It was exempt up to some 7-8%. Or it can be 15 or 20% of salary. So some fixed percentage is known. Here the amount to be contributed by the employer every year is very well known in advance. If the employee's salary is 20,000, 12% of that 2,400 he has to give towards the contribution to provident fund. Employee will also get deducted that amount from his salary, and employer is also going to provide 2,500. Amount is very simple to find out. Why? Because that contribution towards the plan of the employer is fixed. Okay, what percentage of salary every year is to be given to the employee as a contribution is very fixed and known in advance. But in defined benefit plan, benefit given to the employee at the end of the term is fixed. Like gratuity. How do you give gratuity? In income tax you would have studied. Say 20 days salary for each completed year of service at the time of retirement. Means whatever is his salary at the time of retirement, we will give if he has done 25 years of service with us. Right now the employee is 25 years and expected to retire at the age of 60. Means he will be working with the company for 35 years and we give him 20 days salary for every year of service. Means for that 35 years, whatever 20 days salary is accumulated, we will count at what amount of salary at the age of 60. So right now if employee is earning 50,000 per month, we don't have to count on the basis of 50,000. Right now he is earning 50,000, means after 35 years what will he be earning? Maybe after 35,000 he is earning 3-4 lakhs per month from us. Right now 50,000 means, see the level of inflation which takes place every year. So maybe after 35 years, he's still working with the same company, maybe earning 3, 4 or even 10 lakhs per month at that point of time. Whatever is his salary at the time of retirement, 20 days salary for each year of completed service we will give to him. So benefit what we have to give to him at the time of retirement is known, but contribution is not known. Contribution is not known. It is very difficult to estimate. Right now, if you are paying him 50,000 per month, what are you going to pay him at the age of 60 after 35 years? How can you estimate right now? Very difficult. It is not an easy task. Okay. So defined contribution plan is something which is very simple, because what amount you have to contribute? Current year's salary is 12%, 15%, 20%. You know what is current year's salary, and therefore you can find out what will be 12, 15, 20% of that to be contributed to Provident Fund also. The problem is with defined benefit plan, because defined benefit plan means what benefit we have to give him when he retires is known. But to accumulate that benefit, what amount we should keep aside right now is a very complex job, because finding what amount we will have to give him itself is a difficult job. So how to do the accounting for this? If we talk about defined contribution plan, then they are further of 3 types. Okay, if we talk about defined contribution plan, they can be further classified into 3 types. One is multi-employer plan, second is state plan, and third is insurance plan. What are these 3 plans? We will see in detail in the next slide. Okay, what is multi-employer and state and insurance plan? We will see in detail in the next slide. But accounting for this is very simple, because you know you are contributing 12%, 15% of salary of employee. Whatever amount you are contributing, debit it to P&L account, and since it is still payable, you also show it as a liability. Okay, 2 effects. Debit that amount to P&L account, keep a provision for it, and show it as your liability. So accounting is very simple. In all the defined contribution plans, the contribution by employer is debited as an expense in P&L account and also recognized as a liability. All of you must be writing this, or else you can pause the video and note it down. Whereas defined benefit plan, the accounting of defined benefit plan is very complex and explained separately. We'll see that in today's lecture, don't worry. But accounting is very, very complex. Why is it very, very complex? Just now I told you what salary we are going to give to the employee after 35 years itself is very difficult to estimate. Now, whatever we are going to give him after 35 years, we have to calculate on the basis of 20 days salary of each year of service. That is again a difficult job. And on the basis of that, what amount we should keep aside every year for the next 35 years is again difficult task. So accounting of defined benefit plan is very, very complex, and that we are going to see separately. What other problems are also faced in that also we will see separately. To move further, you can pause the video and write it down if you have not written. What is multi-employer plan? Just now I told you we'll explain multi-employer plans and state plans and insurance plans in this slide. Multi-employer plans means various employers come together and establish a trust. Then they hire a wealth and financial planner or manager who invests the money accumulated by all employers for all employees in the best possible manner. In short, it is just like a concept of mutual fund. What do we do in mutual fund? Because individually, if I am investing 5,000 rupees, I cannot invest it in a diversified portfolio. But when crores of people in the public keep on contributing 5,000, 10,000, 1 lakh, 2 lakh rupees to the mutual fund accumulates hundreds of crores of rupees, and they can invest that money in equity and debt market in a diversified manner, and many different types of good securities and shares and debentures can be purchased. That is what multi-employer plans also do. One employer, if he has 50, 60 employees and he has to invest some 2-3 lakh rupees every year for the employee, he cannot invest it in a manner which can fetch good returns. So what is done in multi-employer plans? 70, 80 different employers join together. They form a different trust. They appoint a trustee. Then they hire a wealth and financial planner and manager. Then they all deposit their money in that trust, and then that financial planner or manager invests that money, and whatever return is obtained in that, that is given to the employee along with this principal amount when he retires. So multi-employer plan basically is just like a concept of mutual fund. Various employers come together, form a trust, but trust is formed. Trust means you can have faith on it. So trust is formed and employees' money is not at a risk. Whatever fantastic returns will be generated by that trust, all the benefit of that will go to the employees. So these are called multi-employer plans. Now, are multi-employer plans defined contribution plan or defined benefit plans? In MCQ it can be asked. They are defined contribution plan, because what employer has to contribute is fixed. Returns are risky. They may be more, they may be less. So whatever returns are earned will be given to the employee. It depends on his luck. He may get more returns, and it also depends on the expertise of the financial planner. He may get good returns in future, he may get less returns in future. But contribution of employer is fixed. What amount he has to give towards the employee is very much fixed. So they'll be debited to P&L account every year. Okay. Next, state plans. Now, state plans means what? There is a state government, national government, local government. Okay. They establish this trust. Employers don't make a trust. They establish this trust. Means provident fund we have, EPFO, Employees Provident Fund Organization. It is established by the state and it is very much secure because government controls that provident fund. Okay. They also have a financial planner and they give you a fixed rate of return. So state plans means you invest the money in state plans and whatever returns are fixed and decided by them, that is going to be given to the employee when he retires. So what are state plans? These are the plans administered and controlled by local or state government or national government. For example, EPFO, Employees Provident Fund Organization, is an example of state plan. Okay. Now, there is one question over here which can be asked in MCQs. Listen to that carefully. Whether a provident fund which, underline this, guarantees a specified rate of return. You all have to write this. So underline that. Guarantees a specified rate of return is a defined benefit plan or a defined contribution plan. Just now in the previous slide we discussed multi-employer plans, state plans and insurance plan are all defined contribution plan. However, in a state plan, if you guarantee a specified rate of return, for example, employer says that he will give 10% return on provident fund to the employee. He guarantees that. Now, in case if government does not give 10% but gives only 8% or 7%, who will have to give that balance of 2 or 3%? Employer will have to give from his own pocket. So this becomes a defined benefit plan. Because in case if returns are less, the deficit amount will have to be contributed by the employer. So it does not remain anymore a defined contribution plan. Employer's contribution does not remain fixed. It may be less, it may be zero, it may be more also. Because it depends on the return which the government is going to give and difference return which employer will have to give to the employee. So if employer guarantees a specified rate of return, then state plan no more remains a defined contribution plan. It becomes a defined benefit plan. So this can be asked in MCQ in your exams, noted as an important question. Normally a state plan is a defined contribution plan. But if you guarantee a specified rate of return, then it becomes a defined benefit plan. Okay. It is a defined benefit plan. Lastly, insurance plans. Now, insurance plans means what? You take an insurance policy of all the employers, group insurance, ESI, employee state insurance scheme, you invest the money in that. And then you pay the premium to the insurance company every year, and whatever is the maturity policy value of that amount, of that policy, that amount will be given to the employee whenever he retires. So here in insurance plans, again, there are two different things possible. If employer has no obligation to pay any money to employee, make it employee, okay? Employee on maturity means whatever premium employer is giving is fixed. It's a defined contribution plan. You just have to pay the premium to the insurance company, and whatever is the maturity value of that policy will be given to the employee when he retires. So this becomes a defined contribution plan and premium will be debited to P&L account every year. However, if employer has an obligation to pay fixed amount to employee on maturity, means employer says that for provident fund, for gratuity or for employee state insurance, any particular insurance scheme, we will give you 50 lakhs when you retire. Whatever may be the policy value of insurance, means maybe policy value of insurance maturity comes to 40 lakhs, then also employer has guaranteed 50 lakhs. Then it becomes a defined benefit plan. Why? Because then benefit is defined, that is 50 lakhs which you have to give him when he retires. So if insurance company's policy matures at a value of 40 lakhs only, then remaining 10 lakhs will have to be given by employer from his own pocket. So then it does not remain a defined contribution plan, it becomes a defined benefit plan. So keep this in mind, everyone, that if employer has no obligation to pay any money to the employee, on maturity, whatever is the insurance policy's maturity value, that is only to be given, then it is a defined contribution plan. But if employer has an obligation to pay the money, then it becomes a defined benefit plan. Now, defined benefit plans. This will cover all the points from page 7 to 11. 5 to 7 we covered in the last two slides now. All the theory points from page 7, 8, 9, 10, 11. So you imagine 11 pages of your theory we have written in your notebook in very simple language. Okay. Page 7 to 11. What are defined benefit plans? We have already seen defined contribution. We have seen what is multi-employer plan, state plan, and insurance plan. We have seen even this multi-employer, state, and insurance plan. When can they be defined benefit plans? Now, particularly what are defined benefit plans and its accounting. See, as I said to you, that defined benefit plan means the benefit we are going to give to the employee is fixed, like gratuity, pension fund. These all are defined benefit plans. Okay, and accounting is very complex because of what reasons? Understand it. Factors making the accounting complex. Present age of the employee. See, if you have 500 employees, understand the complexity. All employees will be of different age. Some will be 25 years, some will be 28 years, some will be 35 years, some will be 55 years also. Some employees will retire in the current year, some will retire in the next year, some will retire after 35 years. So present age of employee itself make the things very complicated. The number of years of service of every employee, all 500 employees in the company will have different number of years of service. Salary at the time of retirement is the most complicated thing to estimate. After 35 years, 30 years, 25 years, 15 years, what salary will we pay to the employee? That is itself a very difficult task to estimate. Resignation or death of employee before retirement term is also possible. Some employees, it is not necessary that all will continue till 35 years. Some will retire in between, some will die in between. So all these estimations are required, which is very, very difficult task. Now, what are all these complications we have seen? And definitely it is not a task of a layman or normal people in the company to estimate these things. So because of above complexities, actuarial valuation is required in defined benefit plan. Who is an actuary? Actuary is an expert who estimates the above things, and accordingly yearly contribution is calculated, which is debited to profit and loss account. So actuary is an expert, and I gave you this example in the last session also, that generally life insurance companies hire the actuaries. Okay, it's a certified planner course, and if you do the course of actuary, you'll have lots of value in the market because very few actuaries are there in this country. So actuary is an expert who estimates all these things. What is the present age of employee? How many years will they serve with the company? When will they die? What will be the salary at the time of retirement? This all is not to be done by the company. Who is supposed to do all this? Actuary is supposed to do. He charges very high fees for doing these things. And his valuation is an expert's valuation, which is more or less accurate. Okay, it is not 100% accurate, but very near to accurate. Now, if gratuity is covered under group gratuity scheme with an insurance company, then it will be treated as defined contribution plan. See, in defined contribution plan, we have seen which ones are treated as defined benefit plans. State plans with specified guaranteed rate of return, and that insurance plans where employer has an obligation to pay the money, fixed obligation, they both are defined benefit plan. Same way in defined benefit plan, gratuity and pension, which one is a defined contribution plan? If the gratuity is covered under gratuity group scheme, because group gratuity scheme you buy with the insurance company, here the contribution of the employer is fixed. He has to pay premium to the insurance company, and then whatever is the maturity value of that policy will be given as gratuity to each and every employee covered under that scheme. So if you are taking a gratuity under group gratuity scheme with the insurance company, then it is not a defined benefit plan. It is a defined contribution plan. Now, defined benefit plan continued further. Okay. Two things are important in defined benefit plan. One is you have a planned liability. Planned liability means what amount of gratuity we have to pay after 30 years, 35 years, 25 years, 20 years. That is our planned liability. And second is planned asset. Asset means investment. Obviously, if you are going to pay the money after 20, 25, 30 years, then you must have cash at that time to pay the money. How will you get that cash at that time to pay the money? You'll plan for investments. You'll start investing the money every year right now. It is something like the concept of sinking fund for debentures we studied in the last year. What happens in sinking fund for debentures? Whatever money we have to pay to the debenture holders after 5 years, 7 years, from P&L account, we keep aside certain amount every year so that we accumulate that amount to repay to the debenture holders after 5 or 7 years. Same way here also, whatever is your planned liability to be paid after 20, 25, 30 years, we debit some amount and keep aside from P&L account every year and invest that amount. So whatever is the maturity value of investment plus the returns we get every year will be sufficient to pay to that employee when they retire from the organization. So two things are there in definite plan, defined plan, benefit plans. First, we have to plan the liability, and second, we have to plan the asset. Liability towards the amount payable for gratuity, pension, etc. Asset means we have to plan our investments accordingly so that that amount can be accumulated. Now, provision is to be made for defined benefit and debited to P&L account. And investment of this provision is to be made to generate returns in future. Amount to be charged to P&L account will be including so many things in defined benefit plan. As I said to you, accounting is very complicated. Accounting is something very, very complicated. 6 things are to be charged to P&L account. 6 things in defined benefit plan are to be charged to P&L account. Which 6 things? Following amounts are to be charged to P&L account: current service cost, interest cost, return on plan assets, actuarial gains or losses, past service cost, and curtailments or settlements. It can be asked in MCQ. Remember this. In a defined benefit plan, 6 things are to be debited to profit and loss account or recorded in profit and loss account. Which 6 things? Current service cost, interest cost, return on plan assets, actuarial gains or losses, past service cost, and curtailment or settlement. Each of these 6 things with practical questions we will see in detail. However, in today's lecture, we will see only first 4 things, and even in 4th thing, actuarial gain or losses, we will study 50% only in today's lecture. Because actuarial gains or losses can result out of various things. So some part of actuarial gains and losses we'll study in today's lecture. So initially, right now, I explain you what is the current service cost and interest cost. And we take up an example related to the same. So what is the current service cost? Understand this. Current service cost is the estimated amount to be kept aside from the profits of current year to meet the defined benefit in future. What is current service cost? If after 35 years the employee is going to retire and actuary values that his salary at that time will be 5 lakhs per month. So we find out to accumulate that 5 lakhs per month means we'll find out his 20 days salary. Suppose it comes to 3 lakhs. For 35 years of service means 1 crore 5 lakhs. To get that 1 crore of 5 lakhs of rupees after 35 years, how much amount you have to keep aside every year from right now? Whatever amount you keep aside every year will be current service cost. This year's amount will be this year's service cost, next year's amount will be next year's service cost, and so on. So what is current service cost? It is the estimated amount to be kept aside from the profits of current year to meet the defined benefit in future. And what is interest cost? Interest cost is the interest calculated on opening balance of provision every year. So whatever amount you keep aside in the current year, suppose you keep aside for that 1 crore 5 lakh rupees, you keep aside, let us say 1 lakh rupees in this year. So 1 lakh rupees, whatever you keep aside in this year, interest on that 1 lakh of next year will become interest cost of next year. First year there will be no interest cost because first year means you'll be keeping aside the amount in this year only. So interest will start arriving in the next year onwards. So in the next year, what will be your interest cost? Interest cost. Interest cost will be the interest on that opening balance of 1 lakh next year. Next year again you keep aside, suppose let us say 1,50,000 rupees, then 1 lakh plus 1,50,000 plus that interest. On that you count the interest in the third year. That will be the interest cost. So what is interest cost? Interest calculated on opening balance of provision every year. So right now you all note down this in your notebook. What is the current service cost? Estimated amount to be kept aside from the profits of current year to meet the defined benefit in future. What is interest cost? Interest calculated on opening balance of provision every year. Return on plan assets and actuarial gains and losses we'll see after solving a practical question on these 2 points, current service cost and interest cost. All of you take out question number 6 on page 21 of your study material. All of you take out question number 6 on page number 21 of your study material. And of course, in the notebook, you have to solve this question. So take out your notebooks also. A lump sum benefit equal to 1% of final salary for each year of service is payable on termination of service. Now, this is a defined benefit plan. Why defined benefit plan? Because whatever is your salary when you leave the job, at that time, whatever is your salary, 1% of that final salary will be given for each year of service. So if you leave the job after 7 years, then whatever is your salary after 7 years, 1% of that amount will be given for all the 7 years. If your salary at the time after 7 years is, let us say, 2 lakh rupees, then 2 lakhs 1%. Okay, 2 lakhs 1%, that is 2,000 rupees given for all the 7 years, that comes to 14,000. That is what company has decided. Just an example. Now, the salary in year 1 is rupees 10,000 and it is assumed to increase 7% compound each year. Compound each year means first year 10,000, second year 10,000, 7%, 700, 10,000, 700. Third year 10,000, 700, 7%. That is called compound. So whatever is your salary in year 1, 10,000, 7% increment will be given every year. The discount rate used is 10% per annum. You understand what is the discount rate? The rate used to convert future value into present value. In short, unlike discount rate and right, investments will fetch 10% return. Write that. Whatever money you invest right now will fetch 10% return every year. So whatever amount you require to invest, lesser amount will be required because 10% return will also be generated on the same. So the discount rate used over here is 10% per annum. Show how the obligation builds up for an employee who is expected to leave at the end of year 5. Now we have to solve this example for 5 years. One employee who is expected to leave the job after 5 years, whose current year's salary is 10,000 rupees, it is going to increase 7% every year. We have to find out how the obligation will build up. All of you underline obligation builds up and write down current service cost and interest cost. Obligation builds up means we have to find out current service cost and interest cost for each of the 5 years. Means we have to make the calculation for 5 years and every year what will be the current service cost and interest cost is supposed to be calculated. Start solving it in the notebook. Write down. What will be his salary first of all after 5 years? Right now he is earning 10,000 rupees. So what will be his salary after 5 years? Now you have studied this in time value of money in the last semester. If you have that time value of tables, time value of money tables, you can take out those tables to solve this example, or else you will get it from the branch. You can come and collect from the branch the time value of money tables. Okay. So how will you find salary after 5 years? Future value equals to present value into future value interest factor at 7% for 4 years, because increment of 7% is given in salary every year. So present value multiplied by future value interest factor of 7% and for 4 years. Now why 4 years? He is going to retire after 5 years. So why 4 years? Because increment will not be given 5 times. It will be given only 4 times. Year 1 your salary is 10,000. Year 2 will be the first year when you will get increment. Year 3 will be the second year when you will get increment. Year 4 will be the third year when you will get increment. Year 5 will be the fourth year when you will get increment. In short, 7% rise will take place only 4 times. So if you take 10,000 as year 1's salary, then year 2, 3, 4, 5. 2, 3, 4, 5. That means for 4 years only we have to find out what will be the maturity value. I hope everyone is clear why, though it is given at the end of 5 years, but we are taking the interest factor for only 4 years. Reason, 7% is not counted from today's date. 7% is counted from next year onwards. So 1 year of this year you minus it. Therefore 4 years will only remain to get that increment of 7%. Okay. In time value of money, what examples you used to have? Today you deposit in the bank 10,000 rupees. Today you deposit in the bank means in this year also you will earn 7% interest. But here 7% interest you will not earn in this year. Increment of 7% you will directly get in the second year. So here though the years are 5, we will take only 4 years because increment will be given for only 4 years. Take out that time value of money tables. See this future interest factor table, you have to take out future value interest factor table. You all can see this 7% rate of interest and 4 years. Where do they intersect? 1.311 is the place where they intersect. So what is the future value interest factor? 1.311. We'll take that factor into consideration. What is the present value? 10,000. And what is the future value interest factor at 7% for 4 years? 1.311. Means what will be the salary of the person after 5 years? 13,110. 10,000 into 1.311, 13,110. Now by chance, if this time value of money tables are not given to you in the exams, then also you can calculate it on your own very easily. you count it as 10,000 into 1.07 raised to the power 4. Okay, why 1.07? Do in calculator 1 plus 7%. 1 is your current year's salary. Do 1 plus 7%. Do you all get 1.07 in calculator or not? If increment is 10%, do 1 plus 10%. If increment is 5%, do 1 plus 5%. So 1.07 is the factor to be taken for 4 years. Means you count it in your calculator 10,000 into 1.07 raised to 4. So first do 1.07 into equal to 3 times. Do you all get 1.31079? If you round it off to 1.3108 and multiply it with 10,000, then what answer do you get? 13107. Okay, so if you do 10,000 into 1.07 raised to 4, you get approximately 13,106 or 107 rupees. Okay, you can also do it as 10,000, do it into 1.07 second year salary, again do into 1.07 third year salary, again do into 1.07 fourth year salary, again do into 1.07 fifth year salary. You get 13107.96, means 13108. Here I have calculated 13106. So approximately 13110 or 13106, only difference of 4 rupees. Any of the values can be taken into consideration. Okay, so even if the time value of money tables are not provided to you in the exams, you can do it on your own also. Now 13,106 is what will be his salary after 5 years. See the first sentence, lump sum benefit equal to 1% of final salary for each year of service. Whether you do 13110 or you do 13106 into 1%, will you all get 131 rupees or not? So what is the yearly benefit we have to give to the employee? 13,106 or 110's 1%, both comes to 131. For every year we have to give him 131 rupees when he retires. For every year we have to give him 131 rupees when he retires. Now if I ask you a question, what is the amount to be kept aside from P&L account every year? I repeat, what is the amount to be kept aside from P&L account every year? Obviously 131 rupees, right? No, that's wrong. 131 we have to give him after 5 years, not right now, when he retires. So if you require 131 after 5 years and you are going to invest it at 10% interest, I discussed. What did I discuss about that discount rate? Use 10%. That is the investment's return. So if you are investing the money and investing it at 10% return, what amount will become 131 after 5 years? You'll require some 80-90 rupees to be kept aside in year 1, which will become 131 rupees after 5 years. Then little more amount in the year 2 will become 131 in the 5 years. Little more amount in year 3 will become 131 in the 5 years. In short, that's why defined benefit plan is complicated. We don't have to keep 131 rupees aside every year, because 131 we have to give after 5 years. So very first year lesser amount will have to be kept aside, and as the years go by, every year the amount to be kept aside will keep on increasing, because they will stay invested for lesser number of years. So all of you first of all make this table. What table? Amount will be shown in rupees. Write down years and years 1, 2, 3, 4, 5. Pause the video and make this table of around half a page. I repeat, pause the video and make this table for around half a page. I hope everyone has done that. Now understand this. First you write benefits attributable to prior years, current year, and prior and current years. Understand it first, then you can pause the video and write it down. Okay. What are the benefit attributable to prior years, current years, and prior and current years? In the year 1, benefit attributable to prior years is 0, because it's the first year of service. So for past years we don't have to give him any amount. For first year we have to give 131 rupees. So total amount in the year 1, what we have to pay him? 131 rupees. For that 131 will become the amount of prior years in year 2. Same 131 rupees will become the amount of prior years in year 2. Again for second year we will pay him 131. So total obligation in the second year will be 262 rupees. Now that 262 will become prior year's amount in year 3. Again will contribute 131. So we have to pay 393 rupees at the end of year 3. 393 will become prior year's amount in year 4. Again will contribute 131. We have to pay for that year. So total 524. And then again 524 will become prior year's amount in year 5. Will contribute 131. So total 655. In short, 131 into 5. Total amount what we have to give him when he retires is 655 rupees. Okay, we have to pay him 655 rupees after 5 years. All of you pause the video and write down up till year first. I hope everyone has written that. Now, how will we find current service cost and interest cost? Understand it. How the obligation will build up? Understand it. Opening obligation, write down. Interest at 10%, write down. By interest at 10%, can you all see that discount rate used is 10%? So whatever money we keep aside will earn interest income of 10%. Then current service cost and then closing obligation. All of you write down in this table. Opening obligation, interest at 10%, current service cost and closing obligation. This you do along with me. So pause the video and write down up till year first. Opening obligation, interest at 10%, current service cost and closing obligation. I hope you all have written this. Now in the first year, opening obligation is 0 because past years he has not served. So in the first year there is no opening obligation. Therefore interest will also be 0. Okay, what did we discuss in the last slide? What is interest? I made you write in the notebook. Interest cost is the interest on opening provision. Opening provision is 0, so there is no interest cost. Now current service cost, understand this, we will use present value interest factor table. Take out the same time value of money tables. Now we will use present value interest factor tables. Okay, why present value interest factor tables? 131 we have to pay after 5 years. What is its today's value? We find using present value interest factor tables. Now 10% return is what we are going to get, and as we discussed, we don't have to work out for 5 years, we have to work out for 4 years because you don't invest right now, you'll invest at the end of first year. If you invest any money at the end of first year, it will not stay invested for 5 years, it will stay invested for only 4 years. 5th year you need the money to pay. If you invest right now, in the beginning of first year, it will stay invested for 5 years. If you invest at the end of first year, it will stay invested for only 4 years. So what amount will have to invest for 4 years? See, 10% and 4 years, where do they intersect? Can you all see 0.683? So if you need 131 rupees after 4 years, 131 into 0.683, what is its today's value? 89. All of you check in calculator. 89 plus 10%, 97.9, further do plus 10%, 107.69, this is 2 years value. Plus do 10%, 118.459, this is 3 years value. Plus do 10%, do you get 130.3 means approximately? Do you get 130.3 means approximately 131 rupees or not? So whatever you invest 89 rupees at the end of first year, if you count 10% compound return on that every year, it will become 131 rupees after 5 years. So 131 into that present value interest factor tables, we have used 0.683. So current year, we don't have to keep aside 131 rupees. What amount we have to keep aside in the current year? 89 rupees. There is one more way of counting it. 131 divided by 1.1 raised to 4. In short, how did we get this 1.1? How did we get that 1.077%? 1 plus 7%. Same way, interest rate here is 10%. So all of you do 1 plus 10% in calculator, you will get 1.1. Once again, I repeat, do 1 plus 10% in calculator, all of you will get 1.1. Now because for 4 years we have to count, all of you do 131 divided by 1.1, second time divide by 1.1, third time divide by 1.1, fourth time divide by 1.1, you'll get 89 rupees. Okay, I repeat, 131 divide by 1.1, divide by 1.1, divide by 1.1, divide by 1.1. Do it 4 times. So 131 divided by 1.1 raised to 4, you get 89 rupees. If you don't have time value of money tables, then you can do this on your own also. Okay. Now 89 rupees will be the current service cost, means to get 131 rupees after 5 years, at the end of year 1 we have to invest 89 rupees. This is our current year's service cost. So what is closing obligation? 89 itself. This 89 will become opening obligation of year 2. Now 89 into 10%, what will be the interest? 8.9 means rounded off to 9 rupees. 89's 10% is 8.9. So what will be the interest? What did I tell you is interest? Interest cost is the interest on opening balance of provision. Interest cost is the interest on opening balance of provision. So opening balance of provision 89 rupees, on that 10% 8.9 means 9 rupees is your interest cost. Now current service cost, as we calculated, you can use it in that time value of money table. Now I'm not showing it to you. If you use time value of money tables, then 10% in 3 years. Now 3 years are only remaining, year 2. Like we did 10% in 4 years, 0.683. You can do 10% in 3 years, or else you all do 131 divided by 1.1 raised to 3 means you all do it as 131 divided by 1.1, second time divide by 1.1, third time divide by 1.1. You all will get 98 rupees. So current service cost will become 98. Means at the end of year 2, if you keep aside and invest 98 rupees at 10% return, at 10%, at the end of year 2, if you keep aside and invest 98 rupees at 10% return, it will amount to 131 rupees after 5 years. Okay. Now closing obligation 89 plus 9 plus 98, 196. This 196 will become opening obligation of year 3. Now 196 into 10%, 19.6. So that will be 20 rupees as interest cost of that year. Then current service cost, now you do 131 divided by 1.1 raised to 2 because only 2 years are remaining. So do 131 divided by 1.1 divided by 1.1. Do you all get 108.26 means 108 rupees. So 108 is the current service cost in year 3. The total of all the 3 is 324. 324 will become opening obligation of year 4. 324's 10%, 32.4 means 33 rupees rounded off to 33 rupees. Now again all of you do 131 divided by 1.1 raised to the power 1. So that will come to 131 divided by 1.1, 119.09. So 119 rupees if you keep aside, total of all the 3, 476 rupees will be required. That will become opening obligation of year 5. 476 into 10%, 48 rupees. 47.6 means 48. And last year you have to keep aside 131 rupees only because you are not going to invest it. The employee retires after 5 years, so at the end of 5th year you are not going to invest any amount. So full 131 you have to keep aside in the last year. So 131 rupees if you keep aside in the last year, total amount will come to 655. And that is what we have to give to the employee after he retires. So this is how the obligation of the company will build up every year. In the first year, company will keep aside 89 rupees. In the second year, you'll earn 10% interest on that, then keep aside 98 rupees. In the third year, you'll earn interest on 196, then keep aside 108 rupees. If you keep aside systematically in this manner, 655 rupees will be able to accumulate. Now you can understand how complex is this defined benefit plan. We have taken an example of only 5 years. And so simple example, 10,000 salary, 7% increment. Imagine the position of a joint stock company who has 500,000, 1,500 employees and they are going to retire after 25, 30, 35 years. What return company will calculate? What will be their salary at that time? So many complexities are involved. However, with this example, we have understood 2 points which we have to debit to P&L account: current service cost and interest cost. Now, what was the third point? Return on plan assets was the third point. Okay. Now, third point, we understand return on plan assets. Okay. Current service cost and interest cost, we have already seen. What is return on plan assets? Understand that. Plan assets means what? I repeat, plan assets means what? I told you plan liability means the amount which we have to pay to the employee, pension, gratuity after he retires. Plan assets means what? Investments. Plan assets means you plan your assets, you plan your investments so that you are able to accumulate that amount to pay to the employee when he retires. So what will be the return on your investment? Obviously, the return on your investments are going to be interest, dividend, profit or loss which you earn on sale of investments. All these are your return on plan assets, return on investments. Okay. Now, when we talk about return on plan assets, 2 things are possible in case of return on plan assets in defined benefit plan. One is expected return, the other is actual return. All of you have to write this in your notebooks. Okay. You can pause the video to write it if you get confused. Now, expected return means actuary makes an estimate. Actuary makes an estimate. That's why we are hiring the expert. He will make an estimate. And how do you find this expected return? Plan assets means investments into percentage return expected. Plan assets, that means investments made into percentage return expected. So in the beginning of the year, if you already have investments of 1 lakh rupees, during the year on a particular date, if you invest further 20,000 rupees, then you find investments in the beginning of the year into 10% for whole year. And if you invest in the middle of the year, suppose in this year 20,000, then 20,000 into percentage return for 6 months. So actuary is going to estimate all this percentage return and so on. Okay. Actual return, how do you find out, understand this? Actual means the real return what you have earned. Okay, that was expected. Now the real return what you have earned. Fair value of plan assets means investments at the end of the year. Suppose At the end of the year, your investments value is 2 lakh rupees. Less fair value at the beginning of the year, let us say, is 1,50,000 rupees. Now, less contributions received by the plan means in this year further you have invested 30,000 rupees. I repeat, at the end of the year, you have investments of 2 lakhs. Market value or fair value of that investment is 2 lakhs. In the beginning of the year, your investments were worth rupees 1,50,000. During the year, you have invested 30,000. What is that? During the year, you have invested 30,000 contributions received by the plan. In the beginning, you had 1,50,000. You invested 30,000, so 1,80,000. But now its value is 2 lakhs at the end of the year. Means, can I say that 20,000 of capital gain you have earned? The value of your investments in the stock market has increased by 20,000 rupees. I repeat, in the beginning of the year, you invested 1,50,000. During the year, you invested 30,000. So 1,50,000 plus 130, plus 30, 1,80,000 are your investments during the year. But the value of those investments at the year end is 2 lakhs, means 20,000 of capital gain you have earned. Is that a return on your investment or not? Yes. So fair value of plan assets at the end of the year minus fair value of plan assets at the beginning of the year minus contributions received by the plan means the money which you have invested during the year will give us capital gain. Plus, let us say benefits paid out by the plan during the year means you have received interest of dividend of 30,000 rupees during the year also. So 20,000 plus 30,000, 50,000 is the actual return what you have earned in this investments. Okay. So this is how you'll find the actual return on investments. Note it down in the notebook. Then we take up with its practical questions also. How do you find the actual return on investments? Fair value of plan assets at the end of the year minus fair value of plan assets at the beginning of the year minus contributions received by the plan plus benefits paid out by the plan will give us actual return. However, you all must remember that expected return is only going to be credited to profit and loss account. Return on plan assets is an income. We don't have to debit it to P&L account. We have to credit that to P&L account. But which return will be credited to P&L account? It can be asked in your exams. Expected return is going to be credited to P&L account. And difference of expected and actual return is our fourth point, actuarial gains and losses. So when we record actuarial gains and losses also in P&L account, the combined effect of expected return and actuarial gains or loss automatically records actual return in the books of your accounts. So actual return we don't record directly, actual return we record indirectly. How do you record actual return? Indirectly. First you record expected return in your P&L account, then you record actuarial's gain or loss in the P&L account. The joint effect of expected return and actuarial's gain or loss results into actual return. However, right now you just remember this much, that expected return is what is credited to P&L account. And how do you find the actual return? Fair value of plan assets at the end of the year minus fair value of plan assets at the beginning of the year minus contributions received by the plan plus benefits paid out by the plan during the year. Pause the video and note it down. Then we take up with the practical questions of return on plan assets. I hope you all would have written this. Look at page number 23, question number 12. Be attentive, understand it properly. I will explain you question number 12, then question 13, 14, 15. 3 questions all of you are going to try on your own. Obviously, its solution I'll provide you right now itself. They are very simple and scoring questions in exams. Look at it. The fair value of plan assets at the beginning and end of the year were 2,800 and 3,086 respectively. Now, 2,800 is the fair value in the beginning of the year which we have to minus. Just now we discussed fair value in the beginning of the year we will minus, and end of the year 3,086 will be our starting point. Mark it as STPT. 2,800 mark it as minus. What do you mean by STPT? ST starting PT point. 3,086, which is the fair value of plan assets at the end of the year, will be our starting point. The employer's contribution to the plan during the year is 290, means 290 rupees further you have invested during the year, we will minus. Contribution received by the plan or investment in this year is 290 rupees, we will minus. Benefit payments to retire were 320, so we have received a return of 320 rupees in the form of interest and dividend from the plan, that we will plus. Okay. Calculate the actual return on plan assets. So write down in your notebook, fair value of plan assets at the end of the year 3,086 less fair value of plan assets at the beginning of the year 2800 less contributions received by the plan 290 and plus benefits paid out by the plan during the year 320 rupees. So actual return on plan assets is 316 rupees. Pause the video and solve this answer. For 2 to 3 marks, it can be asked in your exams, and in MCQ, it can be very easily asked. In your calculators, directly you can do this plus and minus what we have marked. So from MCQ exams point of view, these type of small questions are very, very important. Pause the video and solve them. I hope you all would have solved it. Now question 13, all of you try on your own. The following data apply to a company's defined benefit pension plan for the year. What will we do with the fair market value of plan assets at the beginning of the year? Come on, tell me, what will we do? Beginning of the year, we will minus. What will we do with the fair market value of plan assets? Nothing is given means it is at the end of the year. So end of the year will be our starting point. Employer's contribution means contributions what employer has made. Further money what you have invested during the year, you will minus. And benefits paid means the amount received in the form of interest, dividends, etc. we will plus. So calculate the actual return on plan assets on your own. Pause the video and do it on your own. I hope you all would have solved it. Check your answers. Fair value of plan assets at the end of the year 5,70,000 minus at the beginning 4 lakhs minus contribution 1,40,000 plus benefits paid 1 lakh. So actual return on plan assets is 1,30,000. Same way, all of you solve question number 14 on page 23 on your own. Based on the following information, calculate the actual return on plan assets. Benefit payments we will plus. Benefit payment means that interest and dividend received we will plus. Contributions we will minus. Fair market value of plan assets at the end of the year will be our starting point, and beginning of the year we have to minus. So again, all of you pause the video and solve this example on your own. I hope you all would have solved it. Check your answers. Fair value of plan assets at the end of the year 6 lakh minus beginning 4 lakhs minus contribution 1,30,000 plus benefits 1 lakh. So actual return on plan assets is 1,70,000. Now look at question number 15 on page 23. This is a twisted question. Mark it as important question, slightly different. Understand it now. A company reports the following information regarding pension plan assets. Calculate the fair value of plan assets means we will find the value at the end. Actual return is not as. In fact, see in the table, actual return is already given. We have to find the fair value at the end. Now understand it properly. If you make a mathematical equation, that fair value at the, how do you find the actual return? If you make a mathematical equation, that actual return, how do you find? Fair value at the end minus fair value at the beginning minus contribution plus benefit equal to actual return. Take everything on the right side. Take everything on the right side, only keep fair value at the end on the left side. So if you take minus fair value at the beginning on the right side, it will become plus. If you take minus contribution on the right side, it will become plus. If you take plus benefit on the right side, it will become minus. And actual return on the right side already remains plus. In short, whatever we have been doing in finding the actual return, you do reverse everything over here. Whatever we plus, you minus over here. Whatever we minus, you plus over here. Make a mathematical equation, you'll understand. How will you find the fair value of plan assets at the end of the year? On the right side of the equation, we already have actual return. In that, here we minus fair value at the beginning, so you plus it on the right side. Here we minus contributions, you plus it on the right side. Here we plus the benefits, you minus it on the right side. You'll get fair value of the assets at the end of the year. So fair value of plan assets in the beginning of the year will become our starting point. Employer's contribution, normally we minus, now you do plus because they will go on the right side. Actual return on the plan assets remain on the right side, so they'll be added. Benefit payment to retires, normally we plus, if you take it on the right side, they'll become minus. So pause the video and find out the fair value of plan assets at the end of the year. I hope you all would have solved it. Check your answers. Fair value at the beginning 7 lakhs plus contributions received 1 lakh plus actual return 50,000 minus benefits paid 40,000. Fair value of plan assets at the end of the year is 8,10,000. So I hope with this 4 examples you all are clear with what is actual return of plan assets. Okay. Now we understand the 4th point of defined benefit plan, that is actuarial gain or losses. See, we have understood current service cost, we have understood interest cost, we have understood actual return and expected return on plan assets, return on plan assets. Now 4th point, actual gain or actuarial gains or losses. What did I tell you? Expected return is what we credit to P&L account, and actual return and expected returns difference is called actuarial gain or loss. When we record actuarial gain or loss in P&L account, the joint effect of expected return and actuarial gain automatically results into actual return, which indirectly gets recorded in P&L account. So there are 2 ways of finding this actuarial gain or loss. First of all, actuary uses projected unit credit method for making these estimates. Write down this statement in your notebook, mark it very important for MCQ exams point of view. How does the actuary makes the estimates? Actuary makes the estimate using which method? Projected unit credit method, PUCM. Now what is this method? We need not understand. We are doing the accounting. Estimate is the job of whom? Actuary. So he should only know what is this PUCM method. We are not required to understand what is this method, because we are not going to use this method to make estimate. Who is going to use this method to make estimate? Actuary. It is his job, and that's why he is a certified planner, and that's what for he is charging lakhs of rupees from us to make these estimates. So let us not get into the details of what is this PUCM method. It is not our cup of tea. Okay, we are accountants. We are not the certified planners. So who is going to make this estimate? Actually. However, he is going to use which method to make this estimate? Projected unit credit method. Now his estimates are obviously based on assumptions, because you are making an estimate for 20, 25, 30 long years period of time. So there have to be assumptions on that. These assumptions are of 2 types. Okay. These can be asked in exams. Okay. His assumptions are based on demography and finance. What are demographic assumptions? Demographic assumptions are those assumptions which are related to employees, like mortality, death of employee, turnover, etc. And financial assumptions are related to numbers. So numbers like number of years of service, salary, discount rate, etc. Now, actuarial gains and losses arises due to 2 main reasons. One is difference between actual return and expected return. I told you, expected return is what we credit to P&L account. Actual return is different. Difference between the 2 is called actuarial gain or loss. If actual return is more, it is a gain. If actual return is less, it is a loss. I repeat, if actual return is more, it is a gain. If actual return is less, it is a loss. So we will be having practical examples on this also today. Another way of finding actual gain or loss is effect of change in discount rate, because investments rate keep on changing due to RBI regulations. So if discount rate increases, it will result in actuarial gain, because we expect lesser return and discount rate increase, so we will get more return, so it is an actuarial gain. If discount rate decreases, it results in actuarial loss, because we expected more interest but we got less return, so it is our actuarial loss. Both the kinds of examples are covered in your syllabus. However, today we will see only the first kind of example, difference between actual return and expected return. Second kind of example based on discount rate we will see in the next lecture. Okay, so all of you note down this complete portion in your notebook, pause the video and note it down, then we take up the examples on actuarial gains and losses. Yes, now all of you look at question number 8 on page 22. At 1st January 2020, the fair value of plan assets was 10,000. Now, 1st January 2020 means beginning of the year, so we have to minus it. On 30th June 2020, the plan paid benefits of 1900. Benefits paid of 1900 we will plus, and received contribution of 4900, contribution we will minus. At 31st December 2020 means end of the year, the value of plan assets was 15,000. This will be our starting point to find the actual return. Present value of defined benefit obligation is 14,792. Ignore it. Present value of defined benefit obligation means we have to accumulate 14,792 for the employee who is going to retire in future. Okay, it is the present value of our liability. Okay, in today's value, we have to keep aside 14,792 for the employee who is going to retire. Ignore that. Actuarial losses on the obligation of 2020 were rupees 60. This we have to set off and adjust. Whatever are our actual returns and whatever actuarial gain or loss we will get in our example, Against that, we have to set off this 60 rupees. If we get actuarial loss, then actuarial loss will increase with this 60 rupees. If we get actuarial gain, then actuarial gain will decrease by this 60 rupees and net amount will go in P&L account. So this actuarial loss of 60 rupees is to be set off or adjusted in our answer. At 1st January 2020, the reporting enterprise made the following estimates based on market price of that date. Interest and dividend rate 9.25%, realized and unrealized gain 2%, administration cost -1%. So we are interested in this last point. Expected rate of return on asset is 10.25%. I told you expected return on plan assets. How do we find plan assets into expected rate of return? So whatever are our investments, on that we are going to expect a return of 10.25%. Expected rate of return 10.25%. Final amount is what is important for us. Calculate the expected and actual return on plan assets for the year ended on 31/12/20. Also calculate the actuarial gains or losses to be recognized in the statement of P&L account. Interest is compounded annually. Now, you all already know how to find the actual return on plan assets. We practiced in 4 examples just now. So all of you first, from the first paragraph, find actual return on plan assets on your own. I repeat, from the first paragraph, all of you find actual return on plan assets on your own. Pause the video and start solving it. I hope you all would have solved it. Check your answers. Fair value of plan assets at the end of the year 15,000 minus beginning 10,000 minus contributions 4,900 plus benefits 1,900 from the first paragraph. You all get actual return on plan assets as 2,000 rupees. Now, understand how will we find expected return. In the beginning of the year, what is our investments? How will we find expected return? Okay, estimated return. In the beginning of the year, our investments are 10,000 rupees. So on that 10,000, you all count 10.25% return for the whole year. We get 1025. Now understand this. Contribution received by the plan is 4,900. Benefits paid are 1,900. So what is the net amount going from our pocket? We are investing 4,900 and we are receiving 1,900 also. We are investing 4,900 and we are receiving 1,900 also in the form of interest, dividend, etc. So what is the net investment we are making from our pocket? 3,000 rupees. But is the date given? When are we investing that? The date is not given. So we assume we are investing in the middle of it's given. See at the top of the question, on 30th June 2020, the plan paid benefit of 1,900 and received contribution of 4,900. So we would have invested this money on 30th June and the year ends on December. Means July to December, we have to count return for only 6 months. On this net investment of 3,000, how will you count return of 6 months? 3,000 into 10.25% into 6 by 12, 154 rupees. I repeat, the investments value in the beginning of the year is 10,000. On that, you can see in this table, estimated rate of return 10.25% for whole year will get 1025. Then we invest 4,900, receive 1,900. So net investment going from our pocket is 3,000 rupees. On that, we will earn 10.25% return for 6 months. That will be 154 rupees. So what is our expected return or estimated return? 1178. Now actual return 2,000 and we expected only 1178. So it is actuarial gain or loss. It is gain. We have received more return. So from this actual return of 2,000, all of you subtract estimated return of 1178 rupees. What is our actuarial gain? Our actuarial gain is 822 rupees. Now in the first paragraph, there is an actuarial loss of 60 rupees to be set off and adjusted over here. From this 822, we will set off actuarial losses of 60 rupees. So what is the net actuarial gain to be credited to P&L account? 762 rupees. All of you pause the video and solve this example accordingly. So you all already know how to find actual return on plan assets. Further, we have to find estimated or expected return. Actual return is to be compared with estimated return. If actual return is more, it is an actuarial gain. If actual return is less, it is an actuarial loss. Further, we set off that loss of 60 rupees and net amount what we will credit to P&L account is 762 rupees. Pause the video and complete it. Now last example for today, question number 16. I am reading it. All of you try on your own, then you'll find the solution in front of you. Look at page number 23. At the commencement of the year 2020, M Limited estimates expected long-term return on plan assets as follows. Just see the last information, expected rate of return. Do you find 10%? So that expected return on the fair value of plan assets at the beginning of the year and net amount, contribution minus benefit, you'll count at the rate of 10%. The fair value of plan assets on 1/1/20 was 15,000. Beginning of the year we will minus. During the year 4,000 are contributed to the fund, we will minus, and 2,000 is paid out of the fund towards the employees' benefits, we will plus. The fair value of assets at 31/12/20 closing value we will be our starting point. Calculate the actual return, expected return, and actuarial gain or loss. All of you pause the video and try entire example on your own. Then you'll find the solution in front of you. I hope you all would have solved it. See here. Fair value of plan assets at the end 18,500. Beginning 15,000 we will minus, contribution 4,000 we will minus, benefits 2,000 we will plus. So actual return is 1,500. Now estimated return, in the beginning of the year the investments are 15,000. So on that 15,000 we earn 10% return, that is 1,500. Now 4,000 is the contribution received and 2,000 is the benefits paid. So net investment going from our pocket is 2,000. On that 2,000 rupees you'll count 10% return for 6 months, it comes to 50 rupees. So 1,550 is the estimated return. Now actual return is less over here, that is 1,500, and estimated return is more, 1,550. So actuarial loss of, it's a correction, make it actuarial loss of 50 rupees. I am sorry, make a correction, actuarial loss of 50 rupees. Final answer is actuarial loss of 50 rupees. 1,500 minus 1,550. Final answer is actuarial loss of 50 rupees. Okay, so I hope everyone is clear with this type of questions. Second topic of actuarial gains or losses, that is effect of discount rate, which you have written in the notebook, we will see in the next lecture. So maybe in the next lecture we'll be able to finish this chapter. That'll be all for this lecture. Bye everyone, take care, see you in the next lecture.